Perfect, perfect. Welcome, ladies and gentlemen, to CRE in 2024 and beyond. I'm your host, filling in for Bob Coleman, Mike Geske. With us, we have John Winnick of Clark Street Capital, if I could speak English. Brad Salzer of Redstone Funding. Chris Leff, formerly of a oh my gosh, what Chris? I forgot what I was supposed to say about you. I'm so sorry.
Regional bank.
Regional bank. That's what I was looking for.
Bank.
A new bank. And Tim, I'm sorry if I'm going to butcher your name, Mazzetti?
Yes, correct.
Oh, perfect. Of Citus AMC. Welcome all, and John, please take it away.
Excellent. Well, thank you, everybody. This is our first time using Microsoft Teams, so apologize for some logistics we're trying to figure out, but we do feel like more people use Teams, so far so good. We're going to start out with Brad Salzer of Redstone Funding, who is going to give us a macro overview. Brad, take it away.
Thank you, John, and to my esteemed panelists. It's always fun to be with you in person and live, or in any way we can get together. And thank you all for joining us out there. We've got an interesting dynamic group, I think, of different disciplines within the CRE space, and we hope to hit it hard this afternoon. And I want to kick it off with this slide that is, for me, the foundational slide of where we are today, frankly. And I studied, this is back in March of last year, as we were talking about, was it going to be 25 bip increase or 50 bips from the Fed? And I went back to 1955, August of 1955, and I studied the prime rate from that time until March 16th of last year. And then I looked at the annual increase for every year. And I think the slide says it all. It's extremely telling where we are in the market with the spike that we're seeing right now, rates being where they are. And then a little more context, as I study the numbers, the average prime rate, and we lend and prime at Redstone, so I'm using that metrics, which is easily definable. The average annual rate from August of 55 through March 16th of last year was 6.8%. And then if I take that August 55 and I go to the start of the Great Recession, the Great Financial Crisis, that average rate was 7.653%. Then I take the last 14.2 years after the Great Financial Crisis, and the Fed started lowering rates to stimulate our economy, and we've got an average of 375. So the last 14 years, we've been at 375. That's the rate that area of that range of rate is where we all became so enamored in the last 15 years. And I think in large part where we find ourselves today. So just kind of interesting in context for today's webinar. Next slide. Significant to me because Jamie Woodwell with the MBA said in a report last week that CRE lending has fallen by 44% year to date. And that's what this is showing. And when we combine that with, a recent article in the Wall Street Journal of last week, and I'm quoting here, the money has stopped flowing in commercial real estate. That's one of the headwinds we're finding ourselves in. The availability of capital is challenging at best right now. Then we see this bank reg data that just came out, past due loans at Wells rose more than 50% to $3.4 billion in Q3 from $400 million just a year ago. Not picking on them. This is what bank reg data had in the report. PNC, commercial real estate delinquency, doubled in 3Q. And to further quote in that article, it's getting ugly fast with a quarterly increase of delinquencies of about 35 bips. Just yesterday, Monday, I guess, this article came out. They used a very interesting metric here. They're looking at MEZ, MEZ and UCC foreclosures. And the MEZ world layered on another part of the capital stack that filled it up. And we can see from the next slide, John, if you would, I mean, the number of UCC foreclosure sales in the mezz space is really jumping. Significant because those are much easier to foreclose than they are the commercial mortgages or deed of trust world that we typically work in. So there is an awful lot of headwinds going on there, and I think it's very real. All that said, what goes down must come up. And this is from Fred this week, and it shows that the commercial mortgage delinquency really still remains very low. So during the course of the next hour, we'll figure out where we think that might be going. Thank you.
Excellent, Brad. Thank you very much. If any of you have questions, you can ask questions straight in the Q&A queue. We've done a number of these. We'll probably be slightly more interactive than prior ones, but we'll try to take the questions that seem relevant. So
thank you, John. Also, we're on YouTube. If you can't get on and you need something else, we're streaming live on YouTube. Just YouTube at Coleman Report. Sorry about that. Thank you, John.
Let's start with our poll question. Right to the topic of the webinar. CRE in 24 and beyond, is this a Cat 5 or a mild storm?
Do we get to vote?
Who wants to go first?
Well, I think it's a poll question. Sorry.
Yeah, I know. I'm only kidding.
Yep, we got the poll question live in the Q&A section of chat. You can comment on it with or use a reaction, but if in this case we'd like a comment. Or if you'd like to ask your question live, you can also raise your hand and I can unmute your mic.
Sure. Well, let's start. While we're waiting for people to come in, we'll start with you, Tim. Is this a Cat 5, a mild storm, or somewhere in between so far?
Given that we're on the front line of everything that's going on from a servicing asset management standpoint, I'd put it somewhere in the middle. I don't see it as a mild storm. There's some serious structural issues, obviously, with office. Multifamily is starting to feel, or call it, some cracks in the foundation. And obviously, going back to Brad's slide, an 800 basis point increase in rates is going to have a huge, significant impact, especially over a 14-year period where we all gorged on very low interest rates. And we all know what happens when you keep rates artificially low. You have bubbles. And so I do see a lot of these bubbles starting to burst. Office obviously is going to lead it. It's a disruption. It's a structural disruption similar to retail that was disrupted many years ago in the digital environment. But I don't see it as a Cat 5. I would view a Cat 5 as an S&L crisis going back to the late 80s, early 90s, or even the GFC of 2008 through 2011. I do not see it reaching those pandemic heights, if you will.
Chris, what do you think?
Yeah, I would echo those comments. I mean, somewhere in between. We're on the early stages right now, starting to really see the impact of increasing rates on, loans that have been made over the last few years. As we talked about, yesterday, we have projects that, the underlying fundamentals are strong. Rent in multifamily, for example, we're seeing stabilizing properties, rents in excess of what were underwritten maybe 2 years ago. But the increase in rates is making debt service coverage hurdles difficult. You might be, everything's going according to plan. That change in rates turns a 120 or a 125 debt service coverage into maybe a 1.0. And, extension options are pretty much off the table. And, the new buzzword for those is going to be a cash in refinance. So, there is a lot of liquidity on the sidelines, which I don't know that we could have said during the great financial crisis. I can't speak to the S&L crisis in the 80s. But, if that liquidity, remains available, there's going to be a great spot for, that bridge play, to help out some of these projects where underlying fundamentals may be strong, but rates have done the damage.
Brad, give us some red meat.
Well,
Cat 5, right?
Well, yeah, I'm a Cat 5 guy. It's just time. We're due. I mean, and I don't want to be negative. I care deeply about what's going on out there as a proud American. And I'm a debt buyer, so you got to know where I'm coming from. And times have been relatively slow with the delinquency we're seeing. But I'm when I look for the positivity in the market relative to interest rates, which I think are pretty significant. Well, they are. I mean, they're the highest we've seen in so long. When I look at the operating expenses that we'll get into and talk about, I mean, Chris talked about the debt service coverage ratio. I mean, you got a lot working against you. I'm pleased to hear that the pro forma rents are exceeding where they were. I don't hear that a lot. I mean, on a global scale, I'm seeing multifamily rents flat at 0.01% rent growth at best. We've got a war in Ukraine that we're going on 21 months. We've got a new one going on in the Middle East. We've got $33.7 trillion of debt that I don't think we're talking enough about. We got a debt ceiling that our Secretary of the Treasury has kicked down to June 5th now. January 5th, I guess. I mean, I thought we'd be dealing with that this week. And I've got a lot of borrowers that are looking for some SBA takeout financing. And, if the federal government shuts down even for a week, that's really going to throw them into a wrench with their existing lenders that are pushing to get out. So I see a lot of headwinds out there.
Yeah. I mean, a consensus from the polls was, in the middle to mild. No one else was a Cat 5, but Brad,
Well, John, the one
original.
I
guess
caveat.
A follow-up question for Tim and Chris came from Ed Carey. I mean, what concerns or what could happen that would push this from a mild storm to a Cat 5? I got an answer for that as well. But go ahead, guys.
Go ahead.
Yeah, Chris, I'll jump in. I was going to say the one caveat that I did not mention in my prediction as to where this could fall on the scale of mild storm to Cat 5 is exogenous events. As Brad pointed out, we've got some really big things brewing on the horizon internationally, right? Potential invasion of Taiwan by China. You've got literally a group of 4 wackos that are all starting to increase their relationships between Iran, Russia, North Korea, and China. They're
so
all
it's
nuclear.
Not us.
No.
Not us.
Well, wait a minute. We did not talk about the 33 trillion, which now exceeds GDP for the entire country, as something that people aren't talking that much about. But when we had our discussions earlier this week, I mentioned I'm starting to see more and more articles from obviously people a lot smarter than we are, who are watching that very carefully and the effect it's going to have, because payment on the U.S. debt will become the second largest federal budget item by next year. And that's huge. I mean, we're basically in a very, very, I would call it challenging environment from an exogenous event standpoint. If some of those hit, then we could easily see commercial real estate get swept into a very bad economic environment. And, what could be a mild recession or no recession becoming a deep recession, and then all bets are off.
Yeah, let me add to that. I think that the biggest worry that I have is if there is a radical shutdown of lending, if everybody goes on a CRE lending strike, then this gets much worse. You saw last month, Tim, I know you saw this, only 11% of CMBS loans that came up for maturity paid off. So it sounds like you are already seeing some slowdown in the origination market, and that could make things much worse. Switching gears to Chris, when we talked back in June, you talked about a lending environment for CRE with debt yields north of 10, leverage below 60%, 50% for construction deals, pricing in the high 200s, low 300s, construction even higher, perhaps high 300, low 400. how have market conditions changed since we last talked in June?
Yeah, from a pricing standpoint, I think things are pretty consistent with where we were 5 to 6 months ago. Leverage has probably ticked down a little bit, and that's just a function of base rates still rising. At that time, I think we were looking at sizing loans using a 7.5% interest rate, and most recently using an 8.5% interest rate on pro forma NOI for construction deals in place on bridge and term deals. So that higher rate just drops that leverage down a little bit further. I think the bigger change is really just the players. And, I think we spoke last time about a bifurcated market and, kind of picking a midpoint of in that $15 to $20 million range. When you get above that threshold, the number of active lenders in the market, back then was probably, 50 to 60% on the sidelines. Now I'd say it's maybe 75 to 80% are on the sidelines on those loans greater than $20, $25 million. In the smaller scale, call it the 5 to 15, 5 to 20, I think there are a lot of banks under $10 billion that are remaining active. You're seeing some that are, intentionally aggressive, trying to buy market share. And you're seeing the credit unions, having more of an impact from a competitive standpoint for new business than, I recall seeing in my 18 to 20 years of lending.
Yeah. Well, there's a lot of chatter about private credit. And, is private credit, there's two thoughts on it. One, what type of risks are in private credit? That's one side of it. And then to what extent can private credit fill the void in CRE lending vacated by regional banks and smaller banks? I guess this question is for any of you. Is there enough private credit out there for this to happen? And what are your thoughts on private credit?
I would tell you there's absolutely enough private credit out there. If there's one thing we're hearing about right now, it's non-bank lending to fill the void. The question I might ask is, at what rate are we, because we do some of that, willing to lend? And how much equity do we want? And I'm telling you, that's starting with a 12 in my world. So
right.
That's got to pencil out.
To echo what Brad said, as we get ready for our budgeting process for 2024, which began last month, we poll all of our top clients, which are all basically private credit. We've got some insurance companies and some banks, but the bulk of our loan servicing comes from private equity and global asset management firms. And in talking to them, 2023, in most cases, obviously, was a slow capital output. Most of them see a significant pickup in 2024. And as the Fed stops raising rates, which it looks like, and certainly today's inflation number will support them keeping rates flat at least through the rest of this year. They're now even talking about potentially the Fed lowering rates next year. Most of our clients are seeing a much more active capital deployment year in 2024. Which would support what Brad said. There is a huge amount of dry powder out there, but at what cost? And I do believe many of them are on the sidelines waiting for distressed opportunities, as Brad, does on his own book of business.
Yeah, obviously private credit is, for the most part, leveraged by regional banks. So obviously, private credit needs the support of the regionals to give them availability to lend out as well.
Well, the other aspect on that is it's a double-edged sword because, those private lenders are typically lending at, more aggressive leverage points than the banks are. But so you take the higher leverage and then you take the higher rates. And, as somebody that's always been a lender focused on cash flow, these private lenders are lending at sub 1.0 amortizing debt service coverages. In some cases, I've seen, we did some note on note finance. So, I see plenty of opportunities in that private credit world. Many lenders are, looking not focused on cash flow and are lending at thresholds that, don't even support interest only coverage at a 1.0. So, the higher the leverage with the higher rates, it really becomes more difficult. But, echoing what everybody said, the liquidity is certainly there. How they're going to look to deploy that, whether it is the distress, as Tim mentioned, or, as Brad said, focused on the private capital side, I think that remains to be seen. But, I think we'll find out here pretty shortly.
Yep.
And counterpoint, Tim, Hodes Wild just came out with a report, their 23 institutional allocation report, and I'd encourage everyone to read it because my takeaway is that institutional money, the real institutional money, the big money, is waiting to see what happens with their existing portfolio. And there's a lot of scrutiny there. So my takeaway was they were pulling back some. Now, I still think there's plenty of dry powder out there to fill a void, but it's going to be scrutinized. And that's when, it's incumbent upon us to really focus on our underwriting.
Right. Well, back in June, John, when we had our first webinar, I mentioned this, that until there's greater transparency on where interest rates are going to shake out, it's really difficult to make a bet. And, Chris mentioned some office buildings that they actually lent on. They were unique situations where it was the best office building in that submarket. It actually took a major tenant from another building. And so you got very comfortable with a 10-year lease that you made a good bet. But those, I think, were more unique. I think we're going to have some transparency in it, better transparency in interest rates, which will allow lenders to basically jump back in the market with more confidence.
Yeah, we talked about office a lot in our last presentation in June. One thing that happened in the past couple weeks is Capital One, formally announced that they disposed of $1 billion in office loans. It traded at about 73 cents a dollar. These were New York City office loans, and Capital One provided 1-to-1 leverage. And, this was, really the first big sale of office loans of that nature. Obviously, the FDIC took bids last Thursday on the signature assets, so there'll be some more counterpoints. But, for Tim, I mean, we started to see some velocity. Are we seeing some trades in office buildings that, give people some confidence on what values are?
Yeah, one of the biggest issues, because we have a number of large office buildings sitting in our special servicing book right now, and especially on CMBS, to the extent that we can preserve the debt through a receivership as opposed to a foreclosure, where we can potentially sell the asset with debt in place that's obviously more attractive than what a buyer would be able to get in the open market if they could even get it. We try to do that. But the issue we still have, and I do believe this, capitulation has not yet set in. The sellers still believe that their assets are worth more than what they are. And so to answer your question, John, until there's actually an acceptance that we're going to have anywhere from, in my view, for office 20 to 50% reduction in value. And the Signature Bank FDIC book that's now in the marketplace is going to help establish some of that. There's still very little velocity of transactions. And I think you've seen that as well, John. You're in that side of the business. We have an issue when it comes to comps, and therefore we have an issue with what current values are, because appraisals aren't worth the money they're the paper they're written on. There's not enough comps. And so where do you peg value? And so to the extent, and that's where the extensions come in, you can push this down as long as that's not kicking the can down the road. You want to give people time again to have better transparency into where rates are going to be, where capital is, where it's priced, and what its value is.
And going
it's
back
not
to
there yet.
Going back to your first question here, I didn't say it at the time, but that office market is really where I think we'll see the Cat 5. I'm not necessarily ready to say that elsewhere, but office, I think, if we're not there, we're going to be there soon.
Yeah.
Hey, gentlemen, if I could interrupt real quick, John, I don't see your screen anymore.
Yeah, I turned it off because the PowerPoint was over.
Okay. I was just making sure that people were aware. I apologize. Thank you.
Brad, what are you seeing in multifamily?
I've been following multifamily very closely as the darling of the asset class. And, I think it's a really tricky market. I think that in some of our hottest markets, we could be seeing some oversupply, which is going to be interesting. We all, like to follow the crowd. And as they've moved into some of those great markets, they may be overbuilding at a time when I'm most concerned about the operating expenses on the P&L. And, the insurance is the obvious one. We're hearing more chatter about that. But 2 years ago that we were talking more about utilities increasing 16.2% year over year. Wage inflation with what we're paying property management is all shrinking NOI before you get to your cash flow for debt service. And, you know, I think we may still be undersupplied generally in the housing stock, but I think it's one to watch very closely, particularly as some of those constructions to perm come into place, and it's going to be difficult to get, I think, even financed, multifamily financed.
And the bullish thing I would say about multifamily is, so long as you have such a unusual price rent dynamic, in which the cost to rent and the cost to ownership is so out of whack, you know, obviously that could be solved in two ways. Either home prices will come down, thus making them more attractive, or rates come down, or apartment rents go up. So, I mean, I do think that dynamic will support apartment rents for a while, because home prices have been very stubborn.
Right.
Well,
Right.
Yeah, I listened in on a webinar not long ago. I think it was last week with Stuart Miller, who is executive chairman for Lennar Corporation, you know, the largest home builder. And he made the point and used the statistics where we really need 1.5 million units a year to come into the market to satisfy demand, and we're nowhere close to that. And the 1.5 million, by the way, is through all categories: multifamily, single family rentals, build to, you know, rent, and then obviously single family homes. And Brad, you mentioned this the other day when we were having our internal discussion. We have a huge affordable housing deficit in this country. I don't know how it's going to be solved. It won't be solved without government intervention. But that does not address some of the issues, some of the operational issues that you have in multifamily. Hell, the cost of building. And, you know, if you TREP had a really interesting analysis where they compared debt service coverage ratio by age of vintage, right? Pre-1959, 59 through 79, 80 through 99, and then 2000 and beyond. What do you expect? The newer product is performing better on a DSCR basis, and when they can improve their property, amenities, or enhance it, or renovate, they're getting a return on their investment. You're not getting that return on investment on the lower quality, older property. It's interesting. I think that's where you're going to have some issues, and already seeing issues in multifamily.
And to your earlier point, John, on the needing home values to go down to create some balance between the for sale and the rental market, I read a stat recently. It's all driven by rates, obviously, but you know, pre-pandemic levels, to reach pre-pandemic affordability levels, home prices would need to come down by 40%. Or personal incomes will need to go up by 69%.
Don't we all hope?
Neither of those are going to be happening anytime soon.
Well, Chris, you got some expertise in senior housing. You know, from our perspective at Clark Street, you know, after office, probably senior housing is the area that people are most worried about. Talk to me about what you're seeing in senior housing.
Yeah, I mean, look, we've been talking about the baby boomer generation and needing to have appropriate housing stock for them as they're not ready to, you know, move out of their homes on their own and, you know, want to live in a community setting. So the amount of building in that space over the last 10 years has been significant. So you've got that increasing supply going right into COVID, which had a significant impact. And I think we're still feeling the impact of COVID today. Many bank portfolios in the senior housing space are bloated with deals that don't work. Absorption is significantly slower. I mean, the rents that you're talking about, we were talking yesterday, what was the rent for your mom that you were looking at, Brad? $8,500 or $10,500 for a 1-bedroom unit. And you compare that to what we're talking about, you know, on the multi side, I mean, it's significantly higher. You know, on top of an oversupply and maybe less demand than anticipated, you're dealing with operational challenges, primarily on the worker side, the employee side. Maintaining an appropriate level of nursing at these facilities has just been incredibly difficult, especially post-COVID. You know, many projects or properties are resorting to using agency services to maintain minimum staffing levels. However, you know, those staffing levels have a direct impact on, you know, how the future residents are evaluating their decisions. And I happened to be looking at one for my mother recently, and, you know, 120-bed facility had 1 nurse. And, you know, relative to, you know, standard staffing, you know, you need 3 to 4 nurses, you know, for that size facility, and that just doesn't cut it. So ultimately, you're going to go somewhere else. So I think there's still a long way to go in the senior housing space, specifically in the private pay world. when there's some level of government reimbursement associated with a project and call it Medicaid or Medicare reimbursement, I think those projects are going to do better than those that are solely reliant on private pay.
Yeah. Well, got a brief presentation regarding what we saw from the banks and CRE delinquencies in most recent earnings. We're going to start, while we're doing this, we're going to start with the poll question, which will be in the chat feature. What area are you starting to see signs of credit deterioration? Construction, C&I, office, CRE, or no signs of deterioration? While we're doing that, I'll start my presentation. First off, there's certainly you're starting to see deterioration in credit, but keep in mind that we are starting from near record low delinquencies. Actually met with a regional bank that's been in the headlines, and they actually reported lower NPAs last quarter. But you're starting to see the trend overall increase in NPAs. Here you can see the 4 largest banks. Non-performing assets were up 21% for the year. You can see a lot of that was between Q2 to Q3. Charge-offs are up 25%. Provisions are up. So the large banks are definitely showing leadership, if you will, in NPAs. Below, you could see the Wells Fargo disclosure on CRE. Keep in mind that Wells Fargo is the nation's largest commercial real estate lender. So one in commercial real estate lending should always look at Wells because of their status. You can see of the 3,863 of non-accrual loans, 2,790 of them are office loans. So if you look at Wells's portfolio, pretty low delinquencies and non-accruals in everything except office. So office has been certainly leading the fray. If you go to the next slide, this data also comes from bank reg data. This is NPLs in the third quarter. On commercial real estate, there was a 36% increase in the third quarter. You could see how we're coming from very low levels, but they're starting to climb up. The 35 basis point increase in the third quarter that's only happened 5 times since the Great Recession. So that is a pretty significant increase. But overall, bank delinquencies, when you compare them to CMBS, are still lower. Overall, CMBS delinquencies are at a little over 2%, and banks are a little over 1%, 1.31%.
John, can I just ask a question real quick?
Sure.
I mean, one of my concerns or questions about the bank's delinquencies versus CMBS is the bank information is a little more opaque, is it not, than the CMBS transparency?
I mean, I think the big issue is we don't get good data, although TREP attempts to do this, on classified loans. So what you get on banks is pretty much 30 days past due and non-accrual loans, and other loans 90 plus that are still accruing, and so on. So the loans have to be delinquent to really show up on the bank data. I think one of the reasons why the banks are performing better is their office exposure. If you look at the CMBS universe, number 1 is office at 29%. Number 2 is retail. And as we go to the next slide, retail is leading the charge for highest percentage of loans in special servicing. So the banks are looking better, I think, by and large, because they have a less office exposure. Fifth Third, for example, office is only about 10% of their CRE portfolio. I don't know how close that is to other banks, but I would suspect most banks would be a lot lower than 29% in office. And if you look at the data from special servicing rates, this comes from TREP. To me, this is basically the equivalent of loans in workout. So this would be the entire workout universe, if you will, of CMBS loans. Tim, maybe you can give some color there. But you could see the all-time high for special servicing rate was over 13%. And surprisingly, Tim, if you could comment on this, retail is still the biggest headache in the CMBS world.
Yeah, it is an interesting statistical slide. What you should note compared to the great financial crisis of 13.36 overall, remember that these are fixed rate loan for the most part, right? There's some floating rate SASB deals and what have you. That means that you're looking at a wall of maturity issue that's coming up here. And I think you mentioned that, I don't know if it was you, John, or Brad, you mentioned earlier in the presentation about 11% of the loans in office in CMBS have been able to refinance. So what I think you're going to see over time is that office is going to continue to tick up as it has, the red line there. And I think it's eventually going to surpass, the retail, because you're noticing retail is actually coming down over time. I think a lot of there's still some malls. Remember again that CMBS, I hate saying this, and Lisa Pendergrass is going to shoot me, but unfortunately, CMBS almost became the lender of last resort. And so the overall quality of the properties and the loans that were done in CMBS, certainly over the last 5 or 10 years, might not have been as good. What has saved them is fixed rates, lower levels, so they're still performing. I think as you look into 24 and 25, you have a lot of office loans that need to refinance. I believe you're going to see that office delinquency rate tick up.
Yeah.
Gentlemen, we have a question in chat specifically asking about this question. It says from John, I recently read that there is an excess of $75 billion due to the hit refinance cliff between now and 2025. Based on current rates, in order for those loans to meet refinance guidelines in the current lending market, there needs to be an approximate 20 to 25% additional equity injected. Assuming the loans were originally written at up to 75% LTV, this would infer that many of those loans only perform at LTVs below 45% based on original value. If true, this is astounding. Other than the liquidity sitting on the sidelines, what other solutions do you see that might help?
Well, I'm gonna punt to Tim. Tim, you're a special servicer. You've got these loans maturing. They require capital. They require rescue capital. Obviously, you've got the ability with the hammer and threat of foreclosure. But how do you see this playing out?
Well, that's actually a great question. I mean, and again, it goes back to my comment that most of these are fixed rate loans. So when they come up for maturity and you've got that huge increase in interest rates combined with potentially lower valuations or lower market occupancy, whatever the case is, which is office, you got a real problem. What's going on right now in CMBS land? First of all, the only way that you're going to get an extension is if the sponsor is strong, is willing to put in new skin in the game, whether it's a principal pay down or additional reserves. And here's the key, and I bring in all my other special servicing brethren that are just as smart as we are. You want to stay away from kicking the can down the road, right? You don't want to just give an extension so you're delaying the inevitable unless the sponsor has the ability to refinance. We've also run into some situations where you've got a strong sponsor, they have the ability to put in new equity in a deal, but they just don't like the rate environment right now, so they're asking for an extension I want an extension, so hopefully the market rates will come down. That is not something we'll look on very kindly. So again, when those situations come up, bringing in new capital into the deal is going to be key to everything, whether that's through reserves, whether it's through rate caps, whether it's through pay downs. And I think Chris mentioned earlier about the new term in the business, which is, cash in refis. But it is a really interesting question. How big is that gap? The person who asked that question is talking about 75% LTV to 45% LTV. That's huge. I will say one thing, and this is a green shoot. I do believe that office has hit bottom. I don't believe that there's capitulation between sellers and buyers yet. That's still yet to come. I see it happening maybe in Q1. The Signature Bank portfolio is going to give us some clarity into that and other deals. I believe, and look at San Francisco, that's been in the downturn. You're starting to see some green shoots. I do believe that office has hit bottom. It'll slowly start coming up. There's enough capital out there where they see opportunity. You're being able to come in at bases that is way lower than we've ever seen. I think that'll create some momentum and some transactions, which again might be foreclosures and distress, but we might start seeing some momentum in the transaction side.
Yeah.
Just-
Great answer.
real
Go ahead.
quick.
Sorry.
Yeah, no, I mean, I think that, the question was at what level, are we looking at cash and refi? How much equity really needs to go in? And the reality is every situation is different. I think that, the sponsor, their wherewithal, do they have institutional capital behind them? What does their global look like? How many other problems might they be dealing with? I mean, if you're sitting on a couple $1 billion office portfolio, your cash in refinance looks a whole lot different than if it's a guy with an apartment project that isn't reaching an extension hurdle of a 120.
Right.
Certainly, where we talked about the projects where underlying fundamentals are not the problem, and it really is just an interest rate issue. I think from a lender's standpoint, you're going to work with that group. There's ultimately a sale option there where you get out whole. Obviously, the equity isn't generating the yields that they anticipated, when they initially moved forward with a project. But if a project is able to cover its cash flow above a 1.0 interest only, that's probably the threshold that people are going to be looking for, right sizing. That being said, if you're looking at new deals, you're going to look for more equity in there. But when you're dealing with, a problem that was created solely by rates, I think banks are going to be a little bit more lenient in working with those sponsors just to make sure that service.
I saw an analysis from. Go ahead.
Oh, go ahead.
I saw an analysis from Trepp, and I think it was on average you would need a 25% increase in capital to right size many of these loans that are coming due. So those are pretty significant checks for cash and refis.
They had a follow-up question, if I may. They also asked, how big of a role do you anticipate private debt to play in the solution?
I mean,
much larger than previously, because remember again, and there's some really nasty regulatory capital requirements that are sitting out on the horizon there that the banks are pushing back on related to Basel III. If those get implemented, you're talking about, Chris, what was the number you mentioned? You think 75% of the banks are out of the market right now? That'll shut them down. And again, talk about, you lose liquidity, John, as you pointed out, it could get really ugly. Yeah. Hopefully, the Fed and the regulators won't do something stupid to add fuel to the fire.
Yeah, but a big question is, as you look at the credit card delinquencies, I mean, the consumer does appear to be borrowing more on their credit cards. And you can see from the data from Bank Reg Data, Bill Moreland, who runs that, is convinced that the consumer is going to break first as opposed to the commercial borrower. I'm not so certain, but you could see from here, the delinquency rate for credit cards is the highest it's been since 2011. And credit card balances have been growing quite a bit, 150 billion in the last 6 quarters. And you go down to auto delinquencies. Now, keep in mind, we don't have data for auto delinquencies that go back too far, but auto delinquencies are at an all-time high. So you're definitely seeing some cracks within the consumer. On the other hand, the consumer is far more likely to have fixed rate debt. This slide is a great slide. This is from Fifth Third's investor presentation. I haven't seen this anywhere else. But they broke down their portfolio, what's fixed, what's variable. You could see on the commercial side, C&I, 70% variable, commercial mortgages, mostly variable, construction, mostly variable. And then you look at the consumer, so much of the consumer side is fixed. The Fed said that 11% of consumers have floating rate debt. So, it remains to be seen on whether it's going to be the consumer or commercial borrower. Brad, what do you think? Do you think it's the commercial borrower who breaks first, or do you think it's the consumer borrower?
I think I'm really glad you brought this up, because we have seen consumer debt hit these all-time highs. My theory is that we have gotten so used to the relatively glorious 14.2 years, where the proliferation of Starbucks coffees at $4.50 for bad coffee and a $20 martini you know, and 14-year-old girls, no disrespect, getting mani-pedis for $70. This indulgence is not, we have become entitled to it. We're going to put it on our credit card because we're spending more for gas and groceries, and we're going to keep this thing going because, and Tim used the word capitulation. John, I've heard you use it before. I think what the consumer and commercial borrowers looking for, capitulation from rates. We think rates are coming back down any second now, so I can put it on the credit card, I can borrow because it's going to be better mañana. And I think that's very much in flux this week with what I'm hearing coming out of the Fed and Jay Powell.
Well, Brad, you're in a hot market. You're in Tampa. Prices for commercial real estate, residential real estate are amongst the highest from a growth standpoint. What do you see happening in Florida? And you do have challenges with insurance, for example. How do you see the hot markets like Tampa playing out with this new environment?
I mean, a couple of things. One, what we are seeing, and there was an article where Tampa was cited in the Wall Street Journal last Friday, these expensive homes, and by that they've described them as anything over $1.5 million. These borrowers are coming in from out of state and paying cash for homes from, you know, $1.5 million all the way up to $30 million cash on these things. So to my theory about consumer spending, I think we've got a big disparity happening between the haves and the have-nots. What they are doing, though, is keeping our market afloat because they're spending those consumer dollars, which also worries me with the consumer spending. They're going to go to the landlord and they're going to say, look, my traffic is off and I need some rent concessions. I mean, I think that's part and parcel to putting everything on a credit card to keep the spending going if it really does start to slow down. But John, I think and I've lived in great cities like Atlanta and DC. Fundamentally, Florida maintains a quality of life that is difficult to find in other markets, including, I would submit, Texas. So COVID drove a lot of it down, the density of the East. And so I think Florida does well through a downturn. That said, my friend Brian Bailey at the Federal Reserve, the commercial real estate subject matter expert there, reminds me that rates are still up, the highest they've been in 20 years. So, you know, we've all got to deal with this rate unless, you know, you're the only one I know that pays $30 million for cash for a house, John. Maybe you and Tim.
Yeah, Brad, a quick question for you. So which one do you think is going to break first, consumer or commercial?
I think that's a great question. I mean, the commercial needs the consumer. I think the consumer starts to fall first. I just think that they can only extend and pretend so long, which reminds me of the new expression I've heard, because now survival 25 is getting a little trite. It's extend and ascend, because real estate values are not going back up. They are only going one way in the short term, and that's down. So to the extent that lenders are keeping on the books, that could be problematic down the road.
Yeah.
Not to mention maturities.
One thing that's got a lot of chatter, the banking agencies updated their prudent commercial workout guidance since we last talked. Basically teaching bankers how to do workouts again, which, you know, in my opinion, there was virtually no change between the 2009 version. One of the things they talked about was these A/B structures, which, you know, were easier to do in 2008 when rates were near record low again. Obviously, harder to do now. But Chris, what are your thoughts on these A and B structures? I know you started your career in workout. I'm sure you did a handful of these in your career. Do you think they're going to work this time around, and how so?
Yeah, I mean, I think it's a little bit different when you're looking at something like office or everything else. I mean, the ABs work when you've got a good understanding of what the value of your collateral is. And, you know, we're coming into a market where, as we said earlier, appraisals are, you know, probably not the best indication of value. So, you know, I don't know that the ABs are going to work with uncertainty around value and, you know, interest rates where they are. You know, obviously the guidance came out and said they want you to work with borrowers as opposed to moving right to foreclosure. And, again, that really just depends on each situation. If there is underlying cash flow that, remains, I won't say strong, but remains, it's much easier to work with your borrowers on, restructures, TDRs, to be able to work with them. However, if there is no cash flow, if you built a vacant spec warehouse building and, you have a sponsor who's holding out for top dollar rent and you're sitting with a vacant building, an AB is not going to do anything. And frankly, working with that sponsor, might prove difficult if they're really holding out for top dollar.
I mean, Tim, from your perspective, since you work with both banks and non-banks, I mean, any kind of thoughts on level of patience or workout strategies between those two different parties?
Well, as Chris mentioned, it's a different situation than the great financial crisis, where you were so far down that you could feel fairly confident that there's some upside. And we, as a special servicer back then, did very, very well by doing an AB structure and literally 3, 4, 5 years later, recovering over 100% of the loan amount and getting all the investors out. I don't think we have that confidence today. Why? Go back to what Chris said earlier. You've got an interest rate issue, but in this particular instance, depending on the asset and the location, office, you've got a disruption. You've got a functional disruption. And so where's the value going to come in an office that's poorly located, that's basically losing tenancy, and you don't have any investors who want to throw good money after bad? And so that's an issue. You're talking about teardowns. An AB structure won't do you any good there. So again, goes back to some of our view is try to keep the debt in place, try to sell it. I don't think an AB structure, again, depending on the office, if it's an office building, will work as effectively as it did 14 years ago.
Before I ask Brad a question, feel free to put some questions in the Q&A. We're going to now take some audience questions. Brad, being a non-bank servicer and buying loans, hopefully at a discount that's attractive enough for you, how would you say your servicing is different than the banks that you often buy loans from?
That's a great question, but before I answer that, I want to go back to the policy statement that came out June 29th, right after our last webinar, where they are giving guidance on accommodation and workouts. And as a note buyer, I am very sensitive to that policy and what the banks are doing that we buy our loans from. And I think, frankly, that was a free pass, John. I think I've heard it said that just by whispering, I want to accommodate you, it's enough to keep that from being marked down or, challenging it as a TDR. So I think we really do have a pass going on with a lot of these banks right now relative to accommodation and workouts. The other thing I think is fascinating, and Emily McCormick wrote, if anybody can see this, how do I put it up? Bank Director came out, and she's concerned that a lot of the banks are really going to be at a disadvantage because they don't have anybody in a workout department that really has been through it.
Which is why they need to sell their loans.
Well, I mean, I would tend to agree with you. Your first loss is your best loss, as I quote you on that. But this accommodation has really been a bit of a thorn in my side because I'm looking to buy loans that aren't out in market right now. But to answer your question, the goal at Redstone is to know the asset better than anybody, and that means the existing borrower, which kind of ironically is not that hard, but certainly the institution I'm buying it from. And, we all get a little tired and get some deal fatigue, but when we get into these things from the front end, we are really, particularly now, staying on top of them. I mean, we are on top of the taxes. Of course, we're looking for defaults in some cases because that gives us an opportunity to take that 4.5% loan that I paid 92 for and give me a little bit of yield.
Yeah. I mean, the FDIC sale notwithstanding, because obviously that's a very large deal, there has been pretty good pricing. We have a deal bidding tomorrow, another deal bidding next week. There seems to be pretty good pricing for loan sales now. Obviously, if it's office, it's not as good, but there still seems to be a favorable supply-demand dynamic, and there seems to be plenty of money on the sidelines. Brad, sounds like you're seeing strong competition in the deals you're bidding on, and people are paying levels that you don't understand in some cases.
Yeah, I think we always have new competition coming in, and they may not understand the platform completely. We are seeing some spike in bankruptcies. That's certainly a threat to my portfolio. We recently bid on a deal very competitively, I thought. There were 11 bidders. We were 4 of 11 at 88 cents, and it traded at 94.
Wow.
So, and we don't understand it. We just don't understand it. And we'd like to give it our best shot. And, maybe I'd love to know, but I was happy for the bank. I'm always happy for the bank when they get a great execution. It just makes it hard for us to compete in those ranges, particularly, even in the secondary market. I've got to underwrite these things too. And it's a little squirrely out there to underwrite, not knowing what tomorrow brings.
Give it some time, Brad. I think you'll see some change there over the next 6 to 12 months.
Well, I would like to retire before 80. Thank you.
Any other questions from the audience before we wrap up? Let me give people 15 seconds or so to fire anything at us.
Yeah, so far so good.
All right. Any closing thoughts for any of our panelists that we didn't touch on today that you wanted to hit?
I'm going to go back to saying that the exogenous events that we mentioned are the big question mark for 24. If one of those hits, that would significantly impact and catch everyone by surprise. And go back to what you said earlier, Ukraine and war in the Ukraine and now in the Middle East. Notice what the stock market is doing. It blipped, but it's taken it in stride. The potential of a recession has taken it in stride. The market is up hugely today with the new inflation numbers. If you see that stock market, remember what happened in the great financial crisis. If we have that kind of downturn, all bets are off.
Yeah.
And I guess, we're threading this needle. I mean, and maybe I am the most negative one on the call, but it used to be that we talked about the Fed being able to raise or lower rates as a buffer against a challenging economic environment. They've been threading this rate needle so long that, I don't think we're ready to lower rates that quickly if there is some event out there that really does start tipping the scales for us. And the only other thing I'd like to add, just because I think it needs to be said, as a non-bank lender and acquiring notes in the secondary, there's a lot of chatter right now about the regulation of these non-bank lenders, which is a natural progression. I don't think it's an immediate threat, but it's kind of ironic when we are trying to buoy up the financial markets and the loan markets. We start getting slapped a little bit. So,
Chris, any final thoughts?
No, I mean, look, I think that I don't think we're going to see the Cat 5 outside of office, but I think it's going to be a troubling couple of years where a lot of the lenders out there are going to be working through portfolios with challenges. And to that end, I think it was Brad that mentioned most of these banks don't have experienced workout people. I'm going to be doing some workout consulting, so feel free to reach out.
The solution to all your problems is sell your loans. We're happy to do that for you. Well, thank you very much. It's been a great presentation. Mike, why don't you take us away?
All righty. Q&A is clear. So, gentlemen, thank you very much for everything you had to tell us today. And if you have any questions, please feel free to send them to me at Mike@Coleman Report, and I'll forward them to our panelists here and get your questions answered. And with that, thank you all for joining us today. This concludes today's webinar. Thank you.
Good seeing
Thanks for putting it
everyone.
together,
Nice
John.
job.
see ya.